and welcome to the Investing Master Series. My name is James Boyd. Alongside me, my good Canadian friend, Barbara Armstrong. We welcome all of you actually here today. And just a quick reminder, Will, thank you for that. And we'd like to welcome, her name was Lola, Frank, Will, Scotty, Tech One Trades, and many others. Good morning to all. Let's go ahead and hop right in. Now, just real quick, Barb and myself and all of us coaches, we do post educational content and examples on X, so join us there. Barb will actually post her link there in the chat. That way you can just click on it and follow her as well. There's my handle at James Boyd CS, and we'd also do post announcements as well. Now, just real quick, our focus here today is, obviously, we've had some things pull back in the marketplace. Last week on Friday was expiration day. And when you have expiration day, you need to actually talk about how to build new positions going into the next month. Now, not all of our examples are going to be options, but we do have some capital that could be deployed. And we'll talk about that here today on stock and option examples. But that's going to be our focus here, building some new positions. Okay. Now, just real quick as we get started, remember, as we talk about stocks and we talk about options, remember that options carry a high level of risk and are not suitable for all investors. When we talk about the information, it's done for general informational purposes only. The paid money software is provided for educational purposes only. Investing involves risk. And also remember, when we talk about that risk, you should have an understanding of what the strategy is, what it's trying to do, and practice that. So we provide the paid money account so you can practice the strategy to see if that's something you would consider for yourself. And also remember, when we talk about short options like short puts or short calls, those can be assigned at any time up to expiration. Those are called American style options. That might be good or bad, right? But have the forethought of like, are you okay with that? We talk about it more from, let's say, a short put side, cash give puts, and just know that that just means we would be the buyer of the shares at the strike price, even prior to expiration. Now, also remember, but that does mean that we get to keep 100% of the premium, though. Okay. Now, as we talk about, let's say, the market conditions here, we need to bring up a couple key things that we looked at yesterday. We will look at futures prices. We're not trading futures. We need to look at the futures prices because that could affect the sectors, okay, which then could affect the industry groups. Then that could affect the stocks. I'd like to go back to the gold, silver, just real quick. Okay, maybe even throw in copper. Okay, and let's kind of talk about some of those areas just real quick. We will also talk about, let's say, where the indices are or not. And then what we're going to do is we're going to be looking for some pullback trades. And I'm even going to look a little bit into the technology area, which might be a little surprising. Now, let's go ahead and just real quick, let's pull this up. So first off, when I wake up in the morning, the first thing I see when I usually have my phone, okay, I do not want to see the VIX at the top of my watch list. The watch list is ranked by percentage change. If that percentage change has VIX on the top, we know the market's probably down. Volatility, we know that it's been elevated. As of lately, we've struggled to actually get below 16. Remember, 16 on the VIX usually means the S&P 500 is fluctuating about 1%. It has been more volatile. That higher volatility might influence the type of strategies that you pick on purpose, okay? So this is not one club fits all given market conditions. That's not true. Just like, we're not investing in one sector. We know that if the volatility is expanding, the income areas, utility, staples, and healthcare, non-biotech, real estate would probably be getting a push. We'll look at those here just real quick. But if you look at, let's say, the VIX, down right now, but we're still at 19-ish, 20-ish. When you look at the S&P just real quick, okay, the S&P, again, we've said for a couple days now, the market from a shorter term perspective, 2 to 3 days to 2 to 3 weeks, is at best, okay, neutral. That's at best. If this market broke down some and kind of went down to a wider range of neutrality, wouldn't be surprising, okay? The biggest actually thing is when you have the S&P going neutral, something's going up, something's going down, and there's an offset here. And we can see it in the SPX. It's also hard to actually get the SPX to move to the upside if the technology area is not going up and or discretionaries. When we look at, let's say, the NASDAQ itself, yesterday we really talked about, let's say, divergences. And if you look at, let's say, the NASDAQ, how would you read the NASDAQ in terms of the MACD? Is there a divergence? Now, said in one of our examples, we're going to pull up a technology stock that pulled back. Now, when you look at the NASDAQ itself, it kind of has this diagonal line to it. The diagonal line is really created from lower highs. And this class being the Investing Master Series, if you said, I don't know how to trade diagonal lines, I failed as a teacher, okay? So remember the diagonal lines, you're connecting the bodies of the candles where there's more touch points, okay? And if we start to get above that line and underneath on the bottom, there's a little bullish MACD divergence, well, some investors might really be thinking, hey, we could be getting a little turn here where the sellers are losing control and the buyers are starting to come back in. So for the bears, their goal is support, okay? Get the price to fall down to support. A bullish trader's goal, get the stock to go to resistance. So if we fall down to support, those bears might exit those trades. If they're not knocking the stock back down, the bulls say, I'd like to buy at support and try to run it right back up near resistance. Now, this probably tells us that there's some stocks in the NASDAQ that might be trying to get a little push here. Now, this sell-off has been happening for almost the entire month or the entire month of February. Now, if we actually said, let's say the NDX, we'd have to really say SOX. Can anyone actually tell me what you see on the semiconductors? Anything? Now, by the way, how many of you said there was a bullish MACD on the NASDAQ? There is, okay? If we looked at the semiconductors, now this is where I need your help. Don't just sit there and watch me do it, okay? If we look at the semiconductors, can you tell me what are the stocks that are moving in that space? Now, again, I'm going to go with a very limited understanding. All I understand is how I could go to the Market Watch and just pull up, let's say, Dow stocks, NASDAQ list, whatever. If I look at, let's say, the semiconductors, we are getting to the apex of the triangle itself. That apex of the triangle is where that support and resistance lines start to converge on themselves. Could we break it to the upside? Per the teaching that was taught yesterday, MACD has not been able to get below zero. Momentum is staying up. What does that tell us? That probably the chances of breaking out becomes a little bit higher. Super quick. Let's go to Market Watch. What I'm now going to do is going to go to Visualize. Okay. And now if we do this, now let's say in this case, I went to the NASDAQ 100. Okay. Now, why the NASDAQ 100? We just got done talking about that. Okay. Well, in the NASDAQ 100, things that are kind of standing out. Remember, this is a visual watch list. You got Apple right there. You got AMD right there. You got Intel right there. You got ARM. You got QCOM. You got NXPI. You got ON. Got a couple of these here. Okay. Now, when I pull these up like this doesn't mean that they're upward trending. We need to verify and make sure that they're above support levels. Prices above support level, could they actually be maybe a bullish setup, right? Now, I'm going to kind of start with just real quick Apple, just really quick. I also want to kind of point out, let's say, Amazon as well, okay? Now, if I pull it up just real quick, let's say, and then we're going to move to the semiconductors, okay? So quick thoughts here. If I look at, let's say, Apple, would you say that Apple is still in the upward trend? Yes or no? Is Apple still in an upward trend? Now, sometimes when we say, you know what, James, let's go back to the moving average lines that are like a 3-week moving average. Would we say on a weekly chart that there's still an upward trend here? Now, if you go back and look at this, we've had some purple color candles, purple representing that we're below the shorter term moving average, but above the 30-period moving average. And we've been kind of carving a little double bottom. Now, I don't know about you, but when I go into that Apple store, I'm so tempted to just buy stuff, okay? The goal is to leave the store without anything in my hand. Now, if we take a look at this, okay, if we pull this up, let's go to the daily just real quick. What does that look like on the daily? On the daily chart, you're now going to see that the price, it's above the 30, it's above the 10, and at least neutrality. But maybe are we starting to poke back above? Now, a lot of times people think, yeah, but last time, the price went up here and it was a failed breakout. Well, what does that have to do with the next one? Not a whole lot. Okay. So if it went up like that, and you got to remember the market pulled back, it pulled back as well. And here we are again. And it also kind of speaks to, let's take the opposite side of this. The breakout failed, but buyers came back in to buy after a failed breakout. Well, why as an institution would you buy after a failed breakout? Well, maybe they actually don't think it's going to break down again. Okay. Maybe they want to use that opportunity in the short term to try to build a position. Speaking of build a position. Now, let's go back to just real quick the paid money account, which is one of our goals here today. We're going to go back to the AAPL. Okay. Now, a lot of times people say, well, aren't you scared that the volatility is high? No, I'm not scared the volatility is high. That's usually the opportunity. Okay. So the higher the volatility, typically the higher the potential opportunity. I mean, don't you wish you would have bought the Dow when it was at 5,000? I remember when gold was $230 a troy ounce, and we said it was overvalued. Oh, okay. All right. Now, funny how time kind of like makes you look back and say, oh my gosh, I can't believe I said that. Now, what we're going to do is let's imagine the investor said, James, I want to buy shares of stock. Now, what you're now going to notice is we got some capital here. Why? Well, some things got stomped out, other things were sold, exited, prior to expiration, etc. If we said, example given, we want to build a position, stock position, we're going to right click on the chart, going to go down to buy custom, and we're going to go with OCO bracket. Now, when we talk about a bracket, we're talking about having a target and a stop. If we went back and looked at this and said, where is the high? It's really 286. I mean, I'm not sure if we're going to set a target for that. Might be thinking, could it be a little bit higher? Now, what you're now going to notice is there was a nice big upward trend and a little pullback right there. Now, one of the things I want is to kind of take a quick peek at, let me get volatility off so it doesn't squeeze the chart. But if we look at this, could this be like an intermediate flag? What would you say to that? Could it be an intermediate flag? Well, I think sure. Okay. Now, if you get an intermediate flag, like weeks to months and so on, and by the way, let me tell you something I learned about volatility, right? When the volatility in the market is the highest, more investors tend to kind of, I'll check back the market in a week or two. That's actually probably the worst thing to do. Because then the investor comes back a week or two later and they say, my gosh, if I was here, I would have bought down near support. I would have bought when the crossover happened. But the investor wasn't there. So we don't care what type of market conditions are. We're going to be watching all the time, okay? Because when there's that peak state of fear, things are pushed down near supports. There becomes bigger and bigger opportunities from a technical standpoint and a fundamental standpoint. We need to understand that. So if we take a look at this, what you're now going to see is if I pull this up and say, where is that 161? Now, again, we might say, well, gosh, it's pie in the sky, James. How do we know it's going to go there? We don't. Even if we, for example, took a midsection of this, usually if someone's going to get in, they want 6, 8, 10% upside to offset their potential risk. We're going to put a target right about 308, okay? 308. Limit day GTC. Now, underneath us, okay, remember the question we asked ourselves yesterday. Where did the price pull back to? The price pulling back could have fallen down near support. The price pulling back could have made a higher low. You get a couple higher lows, you get a trend line. That trend line can be like a level of support. Now, I'm going to kind of use this moving average area. Let's say 260-ish and change. I'm on a weekly chart, 260-ish, less 2%, and I'm going to set that stop at 254.80. 254.80. Now, the comment is, hey, is volatility heading down? Well, remember, if we just went through the earnings on the 26th a month ago, If the price is starting to go back up, the volatility typically starts to go down. Unusual. Volatility going down, is that bullish or bearish for the stock typically? Well, it tends to be bullish for the stock after you actually finally tipped up to the green here, there. Now, what I'm going to do is, in this case, is we've got to go back to position sizing. I know you're thinking I hate position sizing. I just want to actually do whatever I want to do. That's the problem. In real life, probably doesn't typically happen like that. If we said $7,000 worth of stock, it's going to be about 25 shares of stock. Okay. Now, what I'm now going to do is going to go confirm and send. Remember how the stop works. Okay. The stop is sell if it goes to that price or less. Okay. Now, what we're now going to do is if we click on that, weird, got so much cash. I'll fix that. Okay. So trade number one here is Apple. I want to go back to kind of see what was the price that we were trying to purchase is at, just to verify. 274.06. Why did we actually go stock? Well, number one is we want to use some of that cash. Okay. We're not talking about what's the return on the invested cash. We're talking about what's the return on the whole entire portfolio. Now, the other comment, second example, okay? If I go back to, let's say, we said this semiconductors. If we said semiconductors are bullish, and again, this goes back to top-down analysis in any market condition. What stocks in semiconductors might be going up? Which ones? I know you saw it. Share with me, okay? Well, let's go back to this just real quick. If we said, are there any names that are in that space? Now remember, Market Watch, visualize. This is a visual watch list. If we take a look at this and said, okay, we got information technology, consumer discretionary, okay, communication services, I don't see anything. I'm going to have to actually go down to, so on the left-hand side, if we want to kind of break down the industry groups, so you're going to see that this is sectors, okay, in the white there. But if I said just isolate information technology, pretty please, now we're going to see the industry groups. All we did right there is click on information tech. There's semiconductors. There's an immediate list. Now, if we looked at, let's say, stocks, let's say like AMD, what does it look like? Well, pull it up. I know we're gonna be like, oh, this is sickening. The thing's been just going up. Okay. Well, not necessarily, but you're gonna see that it is one name that has kind of fallen down near support, and it has earnings coming up on 3/3. So what, next week-ish, right around there, price poking its head above the 10-period moving average. That's not the one I was thinking about per se. The one that I was kind of thinking about and looking at is really INTC and ARM. If I just looked at these and said, what do these look like? What does ARM look like? ARM actually looks, it's actually kind of trying to get a reversal as well. If we said, what does Micron look like? Micron is really that upward trending, okay? Kind of tippy-toeing all over the moving average. Pretty obvious, right? So let's come back to that for just a second. And if I look at the INTC. Now, INTC is fallen down near the support area. Now, we're going to show the example of both these. The old highs turning into the new floor. Okay? Now, a lot of times people say, well, how do you know it's going to go back up? You don't know it's going to go back up. These old highs, 1, 2, that was a bounce point here. That was a bounce point here. Why is the color of the candle that light green? Why? Because the price is poking its head back above the 10-period moving average. Now, let's say the investor says, James, I actually don't know if it's going to go up. I want to trade an upside, a bullish trade, but I'm a little concerned about the volatility in the market. Oh, well, now let's kind of open up our strategy toolbox. So let's say the investor said, look, I want to buy the shares, but I'm concerned about, wonder if that support level doesn't hold. But it looks like there's also some volatility here as well. Okay. What type of strategy do you think we could actually do if we said, look, I want to actually, and this is based upon the sample plans. If I went in and said, oh, I know what we're going to do. We're going to do a married put, meaning we're going to buy the shares and buy the put at the same time. Without even looking, I'm probably going to say that's shot down. Now, could someone do it? Yeah, they could. But remember, if we talk about buying puts, 20 to 50 days expiration, delta 30 to 40, if that put is more than 2%, probably not going to be choosing that. If we said that volatility is too high, which is affecting the premium, we're probably thinking about a collar type strategy. Now, what that means is we're going to do it all at once, okay? So trade number 2, what we're going to do here is we're going to buy the shares, thinking that that price might stay above the support. However, wonder if we're wrong. Now, I'm a man, and I'm fully aware. I've been told multiple times by my dear wife that sometimes I'm wrong. And I know that. That's why there's 2 of us. Now, if I go back to the trade, I'm going to click on the trade tab, and I'm going to actually click on the ask price, okay? Now, here's what's kind of nice about this strategy. If it goes up, great. There's maximum gain. If it goes down, great. There's maximum loss built in. We don't have to fluster and say, where's the stop? Did I move up the stop? We don't have to do any of that. What I'm going to do is I'm going to click on the ask price. Okay, so there it is. Step 2. I'm now going to go to the options that are 20 to 50 days to expiration. Now, why did you pick the collar strategy? Well, when you remember I said if you look at the volatility, 67, you ain't going to be able to buy puts for less than 2% of the current stock price. It's not going to happen, okay? It's more like 5%. If I look at these puts, like even with a delta 30 to 40, they're $2. $2 on a $45 stock, you're like 4.5%. See the math? Now, could someone buy a put? You could. It just means the higher price you buy for the put, the more the stock has to go up to break even, making that trade less probable to break even. The investor says, yeah, that's what I like. They might go for that. For our example, no thank you. Now, what we're going to do is going to go down to single order, and we're just going to click first triggers execute. Now, if I do this, that means we can just click on the call we want to sell. We have the shares, sell the call. That's a cover call. That's an income strategy. Now, if I came down and said, okay, which call would we look to sell? Well, first off, let's go look at, let's say, the open interest. Are all strikes equally liquid? No, of course not. You look at this one here, right here at the money. We're not going to do at the money because we don't want to cap the upside that close to the current price. If we look at the one that's a little bit higher, 47, 5,500 contracts, and you look at the one right here at the 48, that's going to be 19,000. Why do we care? Because that number is probably going to affect the bid-ask spread. Okay? Now, the open interest, that's the number of contracts. They're open and unexercised. Okay? Now, the volume, that's today's volume. Those are contracts that were bought or sold. They're not netted off. So if we sell 1,000 and we buy 1,000, that's not 0, that's 2,000. Okay? So the higher the number, the more activity. Now, let's say in this case, we decided we're going to sell let's say, open this up to the 12 strikes. Got anything about that? I don't see anything there. We're going to actually sell the 48. How do you sell the call? Well, just click on the bid. If we click on the bid, that right there is your classic covered call. Now, what's the problem with that trade? Well, it doesn't protect the downside. Okay? It doesn't protect the downside. So if we come over here and say, okay, which strikes are liquid on the put side? Why does the stock investor care about the put? Well, because the put gives us a right to sell a defined risk trade. It's not like a stop where it's theoretical. If you buy the put, you have a right to sell at that price from the time you enter until expiration. Now, if we went down and said which strike has a delta of 30 to 40 and it's liquid, well, if we kind of said which one is liquid, we might say, let's say, in this case, open interest 15,000. Maybe it's the 44 in this case, okay? If I also came down and said, well, I could also do the 43, 7,000, okay, right here. Now, I'm going to tell you the first thing that I need you to do for homework. A lot of times when we've never done something before, we're scared. We're nervous. We just haven't done it, right? I need you to practice in paper money this trade. It's not a recommendation. It's an example. What does this trade teach us? Number one is it's a bullet strategy. The second thing it actually teaches is that we have a defined risk at the 43. Now, we're going to draw these numbers up, okay, $45.50, okay? And on a sheet of paper, I want you to draw where do we have the obligation to sell. It's at 48, okay? And then if we look at the downside, where do we have a right to sell? The answer is 43. All right. So if we look at those numbers, we go from $45.50, that's the current stock price, up to $48. It's not a secret. It's $2.50. All right. Now, if we go from $45.50 down to 43, it's negative $2.50. Okay. So when you look at this in this case, like reward to risk, it's more of like a 1-to-1 reward risk ratio. A caller like this is very similar to like a long call vertical. Okay. The difference is you have the shares. With that, your delta is bigger on the position, but since you have the shares, there could also be a potential dividend as well. Do you like dividends? Some people do. Okay. That long call vertical doesn't have a dividend. The long call vertical typically has a delta of, let's say, maybe 10 per contract. Here, the delta is probably going to be about 30 to 40. Okay. Now, if we look at the position and say, well, are we getting a credit or a debit? Well, the call, we actually get 196. We pay 175 for the put. So we get an additional 20 cents on top. So that reward there is $2.70. If we look at the loss, we said it's $2.50, but if we get 20 cents back because of the credit, the loss is really about $2.30. But the moral of the story is it's like a long call vertical. Now, if we brought this up just super quick, right click, analyze. And if we right click on that call, analyze, and we right click on the put and analyze, what are we doing? Well, we want to see what this looks like on the risk profile. So this risk profile, in this case, what we can see, if I take that off there, you're now going to see that this diagram looks very much like a vertical. That's a true statement. Now, here's the deal. When we also take a look at this and we take a look and see, okay, what's the delta of the trade? The delta of the trade, if we actually put this in, you're now going to see is we have the 100 shares of stock. That's going to be 100 delta. Whatever the delta is for the call and whatever the delta is for the put. And if we put this in, we're going to now see what is the delta. Okay. Now notice if we sell the call, we buy the put, there's a commission for each. Notice that. If we send the order, we're going to look and see what that delta number is. Now remember, if that delta is positive, okay, there's the 100 shares of stock. Check. You sold the call. Check. And you actually bought the put. Check. Now, I said the delta on this would probably be between about 30 to 40. We're a little shy of 30, 26.54. What does that number tell us? That's simple. If that number is 26, so that just tells us if the stock goes up $1, the position overall be up about 26 bucks. Stock goes down about $1, we'd be down about 26 bucks. So for every dollar up or down, it's moving the position about 26. Okay. Take that off. It would be about another 26 to the downside. And this right here, if we go up another dollar, it'd be about 52 bucks. Okay. Now, let me ask you a question just to make sure you're coming along. In a more volatile market, would it make sense to do strategies where the delta is not 100? Would it make sense? Have you ever had like lots of shares and the market is really volatile, and you're watching your account go up, down, up, down, up, down. So here's the thing. You don't have to do that. You might say, look, yeah, I got the shares. Yes. But you might say in certain times, I don't want to be as exposed to that volatility. My goal is not to die from a heart attack early. Okay, I know, because if I die, how does the compounding work for me? Okay, so the biggest actually thing is we're trying to suppress the volatility by putting some protection on the stock. All right, any question? Yeah, so that math, the way that worked right there is we were about 270 reward, 230 risk is what that was. Okay, now this also goes back to, okay, what is the investor's goal? Option number one, get the max 270. The only way you get the 270 is you go all the way to expiration, typically. If the investor got, let's say, 80% of that max gain, they might take that. Okay, so like any max gain type trade, you might be willing to take a portion of that. Okay, now I also want to go back to just looking at a couple other stocks that we talked about yesterday. We did make mention of yesterday KDP that did, after earnings, poke its head above resistance. Now, remember with the stock like this, its earnings, the estimate was 59 cents, the actual was 60 cents. And if you take a look at this, they just announced earnings this morning. Now, let's say the investor said, hey, look, this, now, by the way, why are we bringing this up? Why does it matter? Well, because when you look at the sector of staples, what do you see in staples? Now, we would never say language like, yeah, I don't really care about staples. If you don't care about staples, you don't really understand sector rotation. You don't, okay? If the market is more volatile, the sectors that are likely going to be up are the ones that have lower volatility typically, dividend paying, which that dividend policy could vary, but those are going to be the stocks that tend to go up. Now, they don't go up as much as tech stocks or discretionary stocks, but the biggest actually thing is these are the ones that are probably going to have potentially more holding power on the price of the stock. It doesn't mean they're going to they can't go down, but they're probably not going to be as volatile. These areas of staples, healthcare, real estate, things like that, utilities, they're probably going to be a little refuge, an oasis for some investors that are trying to hide and shun, to some degree, some more volatile areas like tech and discretionaries. Okay, so sometimes it's not about how much money did you make to the upside. Sometimes it's about protecting your capital. Okay, now if I look at the IXR, we're seeing now twice little shallow pullback, orange color candle only. Orange colored candle. And on the right hand side, if we taught you well, you're going to see the orange colored candles are the shallowest forms of pullbacks, meaning the price actually stayed above the 10-period moving average, didn't drop. It didn't go into trend 5, it's in trend 4. And if we actually pull back just for a couple days and we bounce up again, they're staples. So I want to go back to, let's say the investor said, James, I see that staples is getting a little push here, trying to. We did a trade yesterday on KDP, but I want to kind of change the strategy on a new position. If we said in this case, can I buy the shares of the stock? I'm going to do this on purpose. I'm going to buy the shares of the stock on a breakout, buy the shares of the stock, but then at the same time, notice the volatility is drastically different. Instead of like when we looked at Intel, the implied volatility was like 65-ish. Well, the implied volatility is 27. What are you thinking now? The lower that number is, the lower the premiums. Following? Wait, if I go look at something 20, 50 days to expiration, if we go look at something with a delta of 30 to 40, and I say, well, how much is it to buy the put? The answer, 50 cents. For some of you Southerners, 50 cents. Well, in this case, if we paid 50 cents for the put, on a stock that was $30.72. Well, now we pull out a calculator. How much is that? So I like to think about this like the option yield, okay? 50 cents, the option premium, divided by the current stock price. The answer is, survey says, 1.6%. So what that means is if we buy the shares at $30.75, we would need the stock to go up 50 cents, because that's what we're paying for the put. At break even in 24 days from now, we need the stock to be at $31.75. Excuse me, $31.25. So we have a dollar amount, which is the premium, and the percentage is 1.62. Do you think there's a chance that that stock can go up 50 cents or 1.6%? Now, remember, the lower the dollar value is and the lower the percentage is, the probability they can get above break even is a little higher. Now, what I'm not going to do is I need you to practice again. We're going to come back in. We're going to buy 100 shares. Step two, what we're going to do is we're going to buy the put as well. Now, one of the things that's misunderstood about a put is they think, well, yeah, you got a cap gain. No, you don't got a cap gain. You got a defined risk. You got a floor, okay? So those shares, that's unlimited upside, unlimited. Now we're going to go down to single order. First trigger is SEQ. Just means, look, step number one, buy the share. Step two, buy the put or whatever it is that you want to put on. We're going to say first trigger is SEQ. We're going to come over here to the put. We're going to look at the delta 30 to 40 right there. How do we buy the put? Click on the ask price. We click on that ask price, you're going to notice that both rows are in green. Now, I'm going to tell you right now, if you ask most investors, how much do you know about defined risk trades puts to the downside? I'm telling you, not that much, okay? I think this is an area of weakness for most investors. When you understand a collar strategy, when you understand a married put strategy and so on, it's empowering to know that you could take bullish positions that you normally take, probably. Now, by the way, this could be stock-based, this could be ETF-based, and so on. It doesn't have to be just stocks, okay? And now what you're going to notice is we have the right to buy the put. Now, that price moved on us just a little smidge, okay? Now, by the way, how much money is that put tying up? Well, whatever the premium is. So if we spend $50, it's not tying it up. We're just paying that. It's $50. Okay. Now, what I'm going to do is, in this case, go confirm and send. And now what you're now going to see is the max profit is infinite. The max loss, it shows 3,079. But that's not completely true because it's not taking into consideration that $30 put. But we could figure that out very quickly. Well, if we have a right to sell at 30, what's the risk? Well, from 30.78 down to 30, the risk is 78 cents. That's the stock risk. Is that all the risk there is? Nope. You got to also include the put risk. Let's make an assumption that we lose all of the put. Well, it'd be $1.28. Or in other words, it'd be $128 total per 100 shares. Go out and find me trades that you could risk $128. Okay, it's going to be tougher to find. Now, so we have a defined risk, $128. Not a theoretical right to sell, not a maybe, it depends. Okay, we can exercise that put from now to expiration, check the liquidity, and or at expiration. The investor's probably going to want to sell the put or exercise it if the stock was below that inside the week of expiration, or just sell the entire position, the shares and the put, okay? So think about it. If this stock is below the 30 at expiration, they might say, James, I don't want to be in the stock anymore because the stock is below the support level. And why is that important? Because the investor's trying to have positions in their portfolio where the stock it is above the support levels, okay? Now, what I'm going to do, so gave you a homework assignment. Number one, the caller example, the Intel. Number two, the KDP. Okay. The difference in how do we choose the strategy, it really came down to volatility and how it affected the premiums. Confirm, note the commission there. Okay. And now what you're going to see in this case is we're going to send the order. Okay. So what you're going to notice is, let me ask you a quick question. Which strategy is more bullish? Is it the caller strategy or is it the married put strategy? Which strategy is more bullish? Which one? Answer, for sure, the married put. The married put is more bullish because you only have one layer of protection, which is the put. You don't have the short call as well. The delta on that married put is going to probably be right around 60-ish. This example is 64. Okay. So how do you know that? Well, if you buy 100 shares of stock and you buy a put out of the money delta 30-40, you would pretty much get to a delta between 60 and 70 overall on this type strategy. Good job, by the way. Okay. Now, guys and gals, I'm going to tell you right now, some of the most interesting entries sometimes is when volatility happens. The average investors, which you are not, because you're learning this, you're learning that, hey, I'm going to take some shots down near support, but it's going to be with defined risk. The average investor, they're scared, they're nervous. I want to wait to see more confirmation. Let me see what the market does. When they do that, that opportunity, when it's higher, starts to become less and less as it bounces more and more, and that risk becomes bigger and bigger. So understanding puts is really important to kind of take some shots down near support areas and when it's maybe a little earlier in that trend. Now, I'm going to fast fire through a couple stocks that are kind of setting up here a little bit. Now, yesterday we talked about the precious metal list. You remember that? That precious metal list, let's kind of take a quick look at this, okay? Are there any of these in the precious metals that are setting up here today? One that's poking some people in the eye is FCX. Now, remember, when you look at gold, you look at silver, etc., we go back to those charts, and we're not trading the gold price itself, okay? But if we went back to this and said, what does gold look like? Now, remember, on a breakout itself, it's not unusual that on day two that you get a red candle. Unusual. Here it is. The question now becomes is when we get a red candle, does the price stay above the moving average? The second thing is from, let's say, tomorrow or the next day, Wednesday, Thursday, can we get a brand new hold? Which is holding up a little stronger? Is it gold or is it silver? Well, if you go look at silver, that candle is a little bit less red in terms of the body of the candle. And there was somebody, he or she, that bought right on the moving average. So clearly someone's watching these lines because it was literally almost to the penny, okay? Someone's buying. So I think some investors are probably going to keep an eye on those areas. Now, I'm going to go back to this FCX for just a moment. Now, when you look at FCX, it had really built a couple, it had pulled back a number of times, okay? Now, remember I asked the question yesterday, when it pulled back, where did it pull back down to? Where it pulled back, where did it pull back down to? When it pulled back, where did it pull back down to? When it pulled back, here. When it pulled back, it went to here. We normally, when we say bottoms, we say like double, triple, quads, penta bottoms. You know, I think pretty much investors feel pretty comfortable right around the 60 threshold. Now, we could say language like, I missed it. Well, hold on. I mean, if we just are now poking our head through the resistance, we could say right around 60 level support. We could also probably say maybe a little higher, right around 62. Now, the nice thing about options is we don't have to be as directionally sensitive initially to the direction of the stock. In our last example, what we're going to do is we're going to sell a put, which is the obligation to buy the shares at the strike price from now to expiration. Okay? So let's say the investor said, James, I think FCX can continue to go up. might. And I want to try to be the buyer of the shares at a strike price that the investor says, I would be okay in buying. Now, if we said, hey, James, I'm going to choose a strike a little bit higher in the range of delta 30 to 40. Well, if we got as high as we could to delta 30, 40, but not higher than 40, it's really going to be the 66. We're not going to choose the 66 there because that only has 4 open interests. The one that has more is the 65. So last trade here, we're going to sell the 65. Now remember, that is a bullish trade. Okay, your delta is positive. We're going to move this over to 222, and that right there is a cash secured put. It's not shares of the stock. It's the potential for that to become shares of stock. The goal initially is to get the premium, okay? The second goal is to get the shares, okay? The investor said, I just really want the premium, then you just want the stock to go up and stay above 65, okay? So we talked about a collar strategy, defining the risk, trying to help with volatility. Second, we also talked about, in this case, married puts, defining the risk. Go out and practice those. And the last trade we actually talked about here is a cash secured put. It's another strategy that is not as directionally sensitive initially to price movement. I think those are kind of more prudent strategies given the market that we're in. Now, if you have not subscribed to the Trader Talks channel on YouTube, do so. Follow actually Barb and myself, all of us coaches on X as well. There's my handle. I try to post throughout the day as well. Someone may mention, hey, James, you've posted like thousands of times. That's true. Okay, 22,000 posts. So try to be pretty active. That is true. Okay. And also remember that coming up next, we have a webcast coming up right at the top of the hour. Stay tuned for that. And also thank you to Barb and to all of you as well. And remember, with what we talked about, it was done for example, illustrative purposes only. And this has been the class on the Investing Master Series. Stay tuned for coming up at the top of the hour next session. Thanks so much. Take care. Bye-bye.